Hey guys, welcome in our weekly market wrap-up session. I know it's still early for some of you, so really appreciate each and one of you for tuning in today. We have a lot of topics to discuss. There were some important developments in the markets over the last couple of days that are worth tracking. So, first of all, I would like us to have a quick chat about the current state of the market and how the market sentiment has developed over the last couple of days. It's really been a ride, and it has been an emotional ride. So let me know if you guys can see what I'm currently sharing on the screen. The fear and greed index has flipped back into greed territory. So we all remember how about 3 weeks ago it was deep into extreme fear territory. And I made a post on this, how fast the sentiment changes, especially in the crypto market, from extreme fear. Everyone was capitulating, everyone was frustrated, everyone was anxious about a potential recession ahead. And now it seems like greed has returned once again in the markets, that investors are feeling once again excited that Bitcoin and equity markets have been performing well. And for that reason, it just shows how emotional the markets can be, and how irrational investors can become, as nothing has changed in the fundamentals really. From 2 weeks ago to now, nothing has fundamentally changed in the markets, and yet the market sentiment did change. And this is why I always highlight the importance of having an objective analysis, especially in the markets. A lot of people seem to be emotionally attached to their investments, seem to be making decisions based on emotions, which I think is a really bad decision. So because of that, this only highlights how important it is to track objective data rather than narratives and news and everything in between. Because if we do that, then we'll have a complete understanding on what really happens in the markets, and not just the narratives that change on a daily basis. So especially this period is really funny to me, because we've seen headlines changing on a daily basis, from Trump making new deals to Trump making no deals, to tariff rollbacks, to new tariffs and more tariffs, and zero to zero tariffs. And it's all been a crazy ride that we all took. So this only highlights the importance of having an objective analysis on the markets. And because of that, in today's session, we'll go over what exactly happened and what exactly we should expect moving forward. So we have an important chart here, which is the gold one. The gold chart has been telling an interesting story. Over the last couple of months, it has been in this essentially blow off top phase, in which it has continuously gone up and up and up without having any corrections. But now, if we look at it on a weekly time frame, we can see that it's forming an important reversal. And what's even crazier than this is that it has formed an important level, which is the 2.618 Fibonacci level. If we go from the 2011 highs to the 2015 lows, this shows us that the price has closed below the 2.618 resistance level after it failed to break above it. Then we had this sweep. This is called a liquidity sweep. It often marks a capitulation phase for bears in particular, so similar to how this chart would look like if it was inverted. This would show us a capitulation wick essentially, and this often marks a reversal point after this long downtrend. Again, it's inversed, but after this long downtrend, we have this last capitulation wick, which is quickly reversed. So the point I'm trying to make, and this is something that I will cover for Bitcoin as well in one of my upcoming videos on YouTube, and the potential of a blow off top in the coming months, is that gold seems like it has topped out, and in the next couple of weeks it seems like it will correct. So My personal expectations, and I think that this is only logical, is that gold will correct in the next couple of weeks. But in order to have this correction, because let's think from a fundamental point of view, what this correction would imply for the broader liquidity cycles in the markets, it would signal a rotation out of safe assets. So, what does a rotation out of safe assets imply? Well, it shows that risk appetite will increase. And so, I think we can use these technical concepts and technical charts in order to predict what's going to happen next with the narratives and with the market sentiment and so forth. I think these are really useful tools we can apply, especially if we correlate them with one another, as we'll see in just a couple of minutes. If we can do that, I think we increase our chances of being able to predict what's going to follow next. So this is the gold chart I've been tracking. Again, it has retested a very important resistance level, which is this Fibonacci retracement at the 2.618 point of interest. And because of that, I think this sweep marks the last capitulation week for the bears that precedes the next move downwards. But once again, we'll need a narrative. We'll need a story that is told to us by the mainstream media. And this story needs to increase the risk appetite of investors. And, because of that, this will justify, let's say, gold correcting and an increased risk appetite and a rotation out of safe assets and into risk assets. So we all know that one of the main reasons why gold has increased so over the last couple of months and why it has gone up so much is because of the uncertainty in the markets, especially since December and early January when the Trump administration took over. Since then, we saw a lot of uncertainty in the markets, and because of that, there has been a massive rotation out of risk assets and out of equity markets into these safe assets, which is why I think gold performed so well over the last couple of months. But I think that will come to an end, and that will change. So what could the narrative really be in order to see this rotation out of safe assets and into risk assets? We also have quite an important confluence here, which is the Bitcoin to gold pair, which has retested a very important support range. As we see throughout this bull market, this support range has acted as a reversal point in the Bitcoin to gold pair. And each time it got tested, it led to an outperformance of Bitcoin against gold. As we see each time it got tested throughout this bull market, it led to this major expansion. And this signals a rotation out of safe assets into risk assets, which shows an increased risk appetite of investors. So what could be the factor that leads to a higher degree of risk in the markets and an increased risk appetite of investors? Well, I think one of the main factors, and this is a thesis I've covered many times before in some of my past videos, threads, and so forth, which is the end of quantitative tightening. And I think this will be the factor that leads eventually to this outperformance of risk assets on a midterm basis. So over the last couple of years, we've seen risk assets, and there are two main pairs we can use for this: the IWM to SPX pair and the Total 3 and Bitcoin pair. But the concept remains the same. So it shows us how risk assets are performing against traditional and safer assets. So we have the small caps against the traditional equities in the S&P 500, and we also have altcoins against Bitcoin, which is a really similar comparison. And we've seen them underperform over the last couple of years. They have massively bled against the traditional and safer assets. So you might be wondering, well, why? I think one of the main reasons why we saw this underperformance was because we were in a quantitative tightening environment. If we correlate this to the IWM to SPX pair, as I explained in one of my latest videos, I think it is related to their business model. Is in particular, a quantitative tightening environment doesn't prime small caps as an environment with high interest rates doesn't really allow small businesses to grow, because in order to have small businesses to grow, we need to have low interest rates so they can borrow money really easily and grow their operations. Instead, with high interest rates, they aren't able to do so. And as I explained in that video, I think this was one of the main factors why Bitcoin miners have also underperformed over the last couple of years and months, because they weren't able to borrow money. So they had to come up with different sources of financing, which is dilutive measures. But this is another talk, another discussion for another day. What I want us to focus right now on is the fact that these small caps have bled against traditional equities in the S&P 500. So I think that once we'll see this macro catalyst, which will be the end of quantitative tightening, we'll see this underperformance also changing, leading to a midterm risk on environment in the markets and an outperformance of risk assets against traditional and safer assets. So once again, I think that we're close to seeing that. And the latest conferences of the Fed, the macroeconomic data that came in a few days ago for March, essentially confirm us that we're onto this path to the end of quantitative tightening. So a few days ago, we've seen inflation coming out at 2.4%, which is right around the Fed's target. And I think that, since inflation came in so low, the PPI also came in so low, I think we'll need to wait for the April data, which will come out in May, in order to really confirm that, okay, inflation has been cooling off, inflation is no longer a threat for the economy, and because of that, the Fed can finally, step away from their quantitative tightening measures. And with that will mark the end of quantitative tightening, which is something that we have been in over the last couple of years. But if we think about the cause of this, right? Why is inflation so low? Well, consumption rates aren't so high anymore, right? And this shows us that the economy is slowly beginning to be somewhat weak. And on a long-term basis, this should be a warning signal for the markets that we're approaching a top. But on a mid-term basis, however, I think that this will lead to this risk-on environment. And historically, what precedes cycle top and macro top formations is a risk-on environment like this would be. So because of this reason, I think this would make a whole lot of sense to see risk assets finally starting to outperform traditional and safer assets in the next couple of months, leading essentially to a blow-off top phase in risk assets, which precede the actual cycle top formation. And this is why I mentioned the gold chart in the first place. If gold starts to correct, then I think we could have this rotation from safe assets into risk assets. And this is also highlighted in the Bitcoin to gold pair, as we've retested this major support level, which historically has led us to new highs in the Bitcoin to gold pair. So if it would lead us to new highs, then that would be quite something. So we also have the crypto market. This pair relates to the crypto market. It shows us how the total free and altcoins are performing against Bitcoin. And as we see, there is a really similar chart with the one we've just seen with the IWM to SPX pair, where risk assets have been underperforming against traditional and safer assets such as Bitcoin. And the reason for that is, once again, there has been less liquidity in the markets, and with low liquidity, there comes a rotation towards traditional assets that tend to bring long-term gains and are more reliable. So investors aren't seeking as much risk due to the fact that, there isn't as much liquidity in the markets to be spent anymore. So this also comes with the Bitcoin dominance, and why the Bitcoin dominance has kept going higher and higher over the last couple of years. And this is something we'll cover in just a few minutes. But now, let's talk about the total 3 and Bitcoin chart. So it's a very similar comparison with the one we've just made on the IWM to SPX chart, where we've seen this bleed while the quantitative tightening measures were on. But I do think that once the total assets bottoms out, and once the Fed steps away from their quantitative tightening measures, we shall finally see an alt season, right? And I think that this will be the primary narrative in the next couple of months. The end of quantitative tightening, everyone started to call for the start of the quantitative easing measures and stimulus coming and so forth. Everyone thinking the markets are headed higher. And that often marks the cycle top formation. That often marks the euphoria phase, and that marks, the highest risks. So because of that, that's how I think we'll see the markets moving forward. This is the main narrative I see ahead of us. Potentially it will come with the soft landing narrative as well. I think that will be something to track. But this will most likely be it. And I think this is the one that leads to this rotation out of safe assets in the next couple of months into risk assets. The narrative of the end of quantitative tightening, everyone thinking we're headed higher, and this will be just a boost in the risk appetite of investors. And if we think about it, what do market makers want in top formations? Well, they want an extreme risk appetite. They want investors to take so much risk that they no longer think whether we top out, how many risks there are involved by investing at the top, and so forth. They just seek making short-term gains, and everybody buys into the strength, everybody longs, and that is oftentimes what leads to top formations. So once again, top formations only come, and they do come because of the euphoria. If we don't see euphoria, and this is a thesis I've covered for Bitcoin as well. So let's move on to the Bitcoin dominance a bit. Let's talk about that. So everyone called for an alt season over the last couple of years. Everyone called for an alt season, and I say that calling for an alt season is the same with calling for a cycle top formation, because alt seasons only occur when the risk appetite of investors is at its peak. Alt seasons never happen when investors are cautious, when investors are having a tight risk management, and so forth. So calling for an alt season here is like calling for a cycle top formation in Bitcoin when the bull market is just getting started. And the same goes for all of these periods where the Bitcoin dominance went lower for a bit and then went on back higher. Personally, I thought that, the cycle top formation would happen back in December. So once I saw this massive crash, I started to call, for an alt season. I thought, okay, this was it. And that the Bitcoin dominance was headed lower. From here on out, there were some technical confluences to this that were pointing towards this direction. But back then I was wrong. And I knew that calling for an alt season was calling for a cycle top. Personally, I thought back in August, that we would have a last impulse up to $110,000 before we eventually topped out. So once we reached $100,000, I thought to myself, well, this is it. The Bitcoin dominance is crashing. Well, this is pretty much it for this bull market. But the Bitcoin dominance kept on going higher and higher and higher. So we're back to square one. We're back to this phase in which the Bitcoin dominance is gradually going higher and higher, signaling that the bull market is still intact. On the other hand, once we'll see weakness developing in the Bitcoin dominance, that's when we should really be cautious. That's when we should start building a cash position. And as I'll cover in just a few minutes, once we'll see that will mark the point where the risk appetite of investors is at its peak. That marks the actual top formation. Not when the Bitcoin dominance is going higher. The fact that the Bitcoin dominance is still going higher, it shows that investors are still cautious. it shows that in the next couple of months, there is a higher likelihood that we continue going higher rather than going lower, due to the fact that investors aren't feeling as euphoric as they should in top formations. And this has been my main argument for all of the people who, flipped bearish over the last couple of weeks and start calling for a bear market. If truly we were going into a bear market, then this scenario for the Bitcoin dominance should have played out. The Bitcoin dominance should have been around 50%, 45%, if we would have reached this phase, and then it chopped while the price is dumped. That's when the real warning signs come, when the Bitcoin dominance is low and the Bitcoin dominance is showing weakness. So that's pretty much where I would be afraid to buy. Back in 2021, we've seen a really similar thing with Bitcoin. While it was showing strength, a lot of people thought the bear market would come. But once it was showing weakness, that's when people became most euphoric. Back in the summer of 2021, that's when people became most euphoric, because believe it or not, the social risk indicators I've tracked, and this applies to my own account as well. The social risk indicators that track, X followers, YouTube views, and so forth, are at its lowest. And believe it or not, most of that engagement comes from altcoins, not from Bitcoin. And the reason for that is people do not really want to invest into Bitcoin that much. So there are fewer people that want to invest into Bitcoin and to hold over a longer period of time than people who want to invest in altcoins and get rich quick. So because of that, while altcoins have been underperforming, so have been the views and the followers on various social media platforms. And I've seen this reflected into my own performance, that, since December, my views and my followers and the rate of growth has gone down. And this is just another confluence I use in order to determine, well, is the cycle top in or is it not? Because if it was truly in, now interest would have been at its highest. Everyone would have wanted to buy the dip. Everyone would have wanted to, be ready once again for prices to go higher. But instead, what we've seen was a 30% correction in Bitcoin, right? As we've seen here, was a 30% correction in Bitcoin or so. And everyone started to call for a bear market. Everyone started to call for, a crash and a deeper correction, something like this, which I don't exclude. I've made my case on this, that if the cycle top was truly in, and this is quite an important topic that we'll cover in a few minutes regarding the low time frame price action and what that could lead to eventually. But basically, people are calling for this to happen. So maybe this happens, right? You cannot really know what's going to follow next. I think the best approach is to take the markets level by level. And I know this doesn't come from a lot of analysts out there, but this is just the reality. No matter how many confluences we track, no matter how many circumstances we analyze, no matter how much experience we have in the markets, there is no way for certain that we can predict what's going to follow next. There is no way we can do that. And because of that, we need to adapt to new market circumstances and to the confluences that emerge along the way. Once again, I've made my case on this. If Bitcoin truly topped out here, and this was the cycle top, and this was a complacency phase, then in this range, we should see Bitcoin dominance weakness and a rotation towards altcoins. However, I don't think we'll see this rotation from Bitcoin into altcoins until we have the actual macro catalyst that will change things, which, as I covered earlier, I think that will be the end of quantitative tightening. So until we have the actual end of quantitative tightening and until we have a durable shift in monetary policies, I think we're still safe. I think that there is a higher likelihood that prices are headed higher rather than lower. So that's pretty much what I have to say for risk assets related to safe assets and traditional assets. And we must pay attention to these correlations because at the end of the day, it helps us to understand what potential narratives could there be moving forward. So once again, as the gold chart is showing a lot of weakness and it is most likely going to correct soon, what will the mainstream media narratives be? Well, something around high risk appetite, something around a rotation towards risk assets, something about, gold correcting, people not really being scared in the markets, and investors feeling more confident in economics and monetary policies and so forth. And so what could the fundamentals be that lead to those narratives? And that will be a macro catalyst, the end of quantitative tightening. And so we correlate the macro side, as we've seen inflation reaching a very low point. We've seen the PPI also reaching a very low point. The Atlanta Fed is predicting, a negative GDP moving forward. And because of that, the Fed could transition away from quantitative tightening to avoid the recession to fall into to make the economy not go into a recession. Okay, so of course there are two scenarios into that, and I covered it in some of my prior videos. So now let's talk about rate cuts. Let's talk about monetary policies and how they play a role in shaping the markets. So basically, how this works is that the Fed has two possibilities and two options moving forward. The first option, which would be the easier one, that historically is the most chosen. So due to the fact that it is the easiest one, it is the one that is chosen. So that is bring inflation back, stimulate the economy, transition into a quantitative easing environment, bring back inflation. That is the easy option on the short term that will eventually lead to a long-term pain. Okay, so, and I'm not talking about a few months, a few years, I'm talking about decades. So this has been Fed's strategy over the years. Whenever the economy goes bad, just add some stimulus, bring back inflation, and that's the end of the story for a couple of years until the economy rolls over once again. There's an economic downturn, and in order to avoid falling into a deeper recession, the Fed stimulates the economy once again. So that is yet the easy option. The hard option, which would be would bring a lot of short-term pain in the markets for a couple of months or a year or two, would be to let the economy fall into an economic downturn, lead the economy go into a recession, and eventually let it settle, let it come to balance, and then transition away from their quantitative tightening measures. So we've seen, if we look at the probabilities for a rate cut, we see that right now on the CME Fed Watch tool, the first rate cut is priced in June. And that is also my base case. I think that the Fed will choose the easy option, will choose the option to, cut rates and to slow down or end their quantitative tightening measures. And that will eventually lead, as I mentioned earlier, to this rotation out of safe assets into risk assets. However, if the Fed chooses the second option, I think their first rate cut should be somewhere in September. And as crazy as that may sound, it is a possibility that the Fed chooses this option and that they let the economy go into a recession to avoid bringing inflation back. This is related to Powell and his mistake back in 2021 to overstimulate the economy, which has led to 9+% inflation in the United States and double-digit inflation in most countries around the world. And because of that, he may choose not to do the same mistake all over again, but to choose a different path. So, we shall see. I personally think that based on historical references, based on what the Fed has done, I think they'll choose the easy option once again to go for inflation, bring back inflation to avoid, having the economy falling into recession. And these are different correlations we must think about, the political support, the political impacts of letting the economy fall into a recession and not stimulating it. Because if we think about it, what a recession means is a bunch of consumers and a bunch of households that are tapped out and are no longer able to afford the standard of living. Because of that, corporations and companies have to let go of their employees, and that leads to layoffs, that leads to unemployment going up, and that's how recessions form. And that leads to a lot of consumers and a lot of people being unhappy, and that is not what the government nor the central bank wants. So because of that, they choose the easy option to stimulate the economy, keep the consumers happy, and because else you would just have a bunch of people and a bunch of consumers that are unhappy, and that leads to a lot of social problems. So they want to avoid that, and in order to avoid that, they stimulate the economy. So there are a bunch of correlations to that, and again, based on historical references, this is the most chosen way. So because of that, I think this will happen once again. And if we correlate the monetary policies with the S&P 500, we'll find a really interesting thing. And that is that over the years, the S&P 500 has performed not based on how much liquidity was introduced in the markets. So we see here, for example, that the Fed was holding rates at 5.5%. So these were historical highs, levels that haven't been seen since early 2000s. So 20 years, over 2 decades, over 2 decades have passed since 5.5% in interest rates have been seen. Yet, we had a really aggressive bull market. And you might say, okay, there was a lot of liquidity that was injected into the financial system, back in 2021 that kept the markets rolling. Yes, there was that, but also there was a really strong investor sentiment. So after all of the recession fears, all of the anxieties back in 2022, back in 2023, there has been a rotation from that and a shift in the market sentiment towards confidence and towards conviction in the economy. Monetary policies were really easy to predict, and because of that, this has led to a very high risk appetite in the markets. And based on that, I think that markets do not really care on how much liquidity is being injected into the financial system, but they care about how market participants feel. Because at the end of the day, what really drives market prices are investors and their beliefs in how the markets and the economy are going to perform. And when the Fed kept rates at historic highs, even though they were so high, the markets rallied. Because the monetary policies were really easy to be predicted. It was really easy to say that the Fed is going to hold for another month, for another 2 months, or for another 3 months. It was really easy to say that. So monetary policies were predictable, and because of that, as they weren't a variable anymore, that has led to a high risk appetite. That was the main factor behind why markets rallied. So I believe that. And now we're in a really similar environment where we have all of these uncertainties. We have all of the fears regarding a potential recession, a potential economic downturn, and so forth. And now we're sort of transitioning away from that into an environment where monetary policies become predictable once again. So I think that the macroeconomic data in April will confirm us that, but I think that we'll have one more rate cut in May, followed by one more rate hold in May, followed by a rate cut in June, and after that we'll have to see. So this is how I see the monetary policies moving forward, and I think that if we do see them like this, it would be somewhat bullish for equity markets, but really bullish for risk assets. So if monetary policies become predictable once again, if investors gain confidence into the economic side once again, I think that will lead to higher prices, but not in equity markets in particular. I think that the main focus right now will be on risk assets. And as I highlighted earlier, we have the IWM to SPX pair, which is currently in this bottoming formation, as we see right here. And because of that, I think it's likely that the main focus right now will be on these risk assets and how they will perform moving forward. And so I think that it's likely that we'll see equity markets entering this complacency phase, where there is a lot of volatility, and this volatility results in high trading volume, which high trading volume is what allows market makers to trade freely and most likely distribute. That's what market makers want. Both in accumulation phases as well as in distribution phases, both are marked by high volatility. And because of that, that leads to a high trading volume, as if you have the price swinging a lot, then you trigger all of this liquidity in between and all of these levels. Instead, if you have a low volatility, because you have such a thin bid and ask spread between the swing highs and the swing lows, then you don't have that much volume. And that's not what market makers want, especially when they try to either accumulate or to distribute. So I think that if we do see the base case for the Fed playing out, it will essentially lead to this distribution phase that coincides also with a complacency phase in equity markets. And I'll have a video on this soon, but I do think that once we'll see this complacency phase in equity markets, we'll see a rotation out of the traditional and safer markets into the riskier markets. And this complacency phase, I think, will lead to the next leg up in Bitcoin's price. So if we let's actually add Bitcoin to this and see the impacts that it could have. So I think that if we were to see this complacency phase ahead, a lot of people have been talking about the decoupling of Bitcoin against the S&P 500. And I think that on a low time frame basis, both perform quite the same. I don't think, they tend to decouple that much. Maybe they do, but oftentimes they just lag to one another. So, one goes down and then the other catches up, or one goes up and the other catches up later. Most of the times that is what happens, not necessarily that they decouple from one another. But I think that this decoupling between the stock market and Bitcoin could be on a high time frame basis. So meaning that this complacency phase, and while the S&P 500 could struggle, Bitcoin could have this move to the upside, that precedes the actual cycle top formation. So something around this, and eventually entering a distribution phase itself, and later on start the next leg down that would coincide with the bear market. So that would make a whole lot of sense in my opinion, and especially with the upcoming macro catalyst that we could see in the next couple of months, this would make a whole lot of sense to see a distribution towards these risk assets, and having equity markets entering this complacency phase that would allow institutional investors to distribute, and it would also act as a trap for retail investors who are late to the party, as always, and who try to buy in equity markets, but now the focus is on risk assets. And that would lead essentially to the last rotation and the last blow off top in the market. So, as we all know, and so let me actually make a correlation with altcoins for a bit. So I said a couple of minutes ago when we were talking about the Bitcoin dominance and the Bitcoin dominance going lower, what that would imply for the broader cycle, that calling for an alt season is like calling for a cycle top formation. The same concept applies to a broader scale, in which it applies to a distribution towards risk assets, such as between gold and the S&P 500 and Bitcoin. So these three major asset classes that have the same concept that is applied to altcoins and Bitcoin. So it is the same concept of distribution towards risk assets because of the elevated risk appetite in the markets. So it is the same concept, just at a broader scale. I think this would pretty much make a whole lot of sense to see it this way. And it is the same concept that would play out for equity markets and Bitcoin as it is for altcoins and Bitcoin dominance to go lower. So I hope that makes sense, because from a fundamental level, it certainly does, to see this sort of distribution towards risk assets that would coincide with and would precede a cycle top formation and the macro top formation rather. So this is pretty much how I see the markets moving forward. This is, I think, the most logical outlook from a fundamental point of view, and this is how I currently correlate the macro side with the liquidity cycles between different asset classes, and how it would impact Bitcoin and altcoins moving forward. So now I want us to have a quick chat about how the market are pricing in things. So moving to an event that happened this week, we had a lot of earning reports, but something that really caught my attention was Tesla and its earning report. So it was a surprise, but by 57% negative. So the consensus for an EPS was at 0.35 cents, and it came in at 0.15 cents. So that is just extremely low. However, the price bounced by over 20% after this earning report release. So why was that? A lot of people have wondered, why did Tesla go up after that terrible earning report? And my argument for that is, the markets price in events. I think everybody expected Tesla to have a weak earning report. Their sales in Europe went down by a lot. And I also covered this in detail in some of my prior threads on X. Why did the Europe why did sales drop? And I think the argument for that is not necessarily that the Tesla brand was impacted that much. I don't think that was the main cause. I don't think that people aren't buying cars because, some of Elon's statements or some of the interpretations of mainstream media and so forth. I don't think that is the reason why people aren't buying cars anymore. That just doesn't make a whole lot of sense. But I think, from a macroeconomic point of view, if we track what's been happening in Europe, we'll see that the GDP for the fourth quarter in 2024 is at 0%, meaning that there is no economic growth in Europe. And, that shows how weak European economies are. And because of that is the real motive why I think there haven't been a lot of car purchases in Europe, and why Tesla's sales in Europe also went down. So it's a bad macroeconomic period for automotive industry as a whole, I think, and this is why what I think led to this underperformance of Tesla and led to this really weak earning report. So that is just to highlight some of the correlations between, how we can correlate the macroeconomic side with a company's, you know a company's fundamental outlook, and their business model and how it operates, and how the markets are pricing in that. So essentially what we saw back in December, the markets were pricing in perfection. They were pricing in the relationship between Elon and Trump, potential for a lot of partnerships, and a lot of things that could arise from that. So the markets back in December were essentially pricing in perfection, and this applies to all markets, not just Tesla. And we had the talks about the Fed and how the Fed would lower their interest rates and how everything was so great, and that led to a really high risk appetite of investors. So because of that, then the market stopped out, and since then markets were in this downtrend, and Tesla has corrected by over 50% from the highs in December. And I think that with this drop, this weak earnings report was priced in, right? The markets went down before the actual earning report, and once eventually that weak earning report was out, then that got out of the way. And I think that if you look at this, I think it's safe to say that the markets aren't performing based on past events, but are foreseeing to new events that could arise in the future, which is why I'm a big believer, by the way, in the efficient market theory, that the markets tend to price in all of the information and all of the potential future information that could arise. So it's a really interesting concept, that is the efficient market theory, and I'm a big believer in it. And I think that this shows us how the markets are pricing in events. A lot of people expected Tesla to go lower if they would have a weak earnings report. They did, but the prices have gone up. A very similar thing has happened once again back in October of 2024. We had a very weak earnings report, and Tesla jumped by over 20% in one day. So again, the same concept that played out once again. If we correlate this with a technical perspective, we'll find that this is a very important level for Tesla. This is a support range that, as we see, has acted as a reversal point many times in the past. So in 2021, once again, as a support range, then acted as a resistance range before it eventually broke above it, then has acted as a support range once again, as a resistance range, then eventually as a support range once again, and now it has acted as a support range. So this is how we can correlate the technical side with the fundamental side in order to gain a complete understanding of what's been happening behind the scenes and what could follow next. So I think that right now, a lot of people have been hating on Tesla. I think Tesla is a great long-term investment. I'm a big believer in Tesla on a long-term basis, and I think that they have a lot of potential to grow from a fundamental point of view. Still, they are a leader in many things. There is the narrative around China and China taking over, and them being a leader in the electric market and the EV market. But I don't think that. I think most of it is propaganda. I don't believe in China being a leader in that department. Tesla has been really making a lot of improvements especially with the FSD and all of those sort of things. And they're sort of transitioning away from simply being a company manufacturer, a car manufacturer, and are more transitioning into the technological side, because behind all of those FSD and AI driving, there are a whole different spectrum of a business model. There is a completely different business model that and with all of their data centers, all of their you know high power computing machines and everything. uh, I think that Tesla has a lot of room to grow from a fundamental perspective. So they've been really doing some great things, and I think that their long-term potential to grow is great. So I just want to highlight that. Those are my beliefs on Tesla. When a company like Tesla falls by 50%, it often marks a great opportunity to buy. And this is what I've done. So back in December, I publicly mentioned that I was scaling out from most of my spot holdings. The company is, as great as fundamentals may seem, when the prices are getting so irrationally high, especially on such a short-term basis, that is when you want to scale out of your holdings. No matter how much of a believer you might be in a company, when the prices go up so much, you want to take profits and you want to scale out of your positions, because eventually you'll be able to buy it back lower. And the point in which you want to have conviction in a company's fundamentals are not at range highs, because the range highs, everybody is a big believer in the company's fundamentals. Everybody says how great that company is, and I've seen this playing out times and times again with various companies. Now, the point where you want to be a big believer in the company's fundamentals are at the range lows, where everybody loses conviction, where nobody says that that company is great. And this is sort of what Warren Buffett has also promoted over the years with value investing. How you should be a believer in a company's fundamentals while it is still undervalued. And that is something that a lot of investors fail to do. And what I try to do when I'm analyzing a company and I'm looking at it from a fundamental perspective, I'm seeking it to still be undervalued on the price. Because if it is here, yeah, the fundamentals may be great, but they're already priced in. So that no longer helps me all that much, does it? Okay, so that is Tesla and their earnings report, and I hope I've offered some clarity into how the markets are pricing in events and how this whole pricing in thing works. So I hope I offered some clarity into that. Now I want us to move on to Bitcoin and my thoughts right now on the low time frame price action, and what's been happening over the last couple of days. So I know many of you have watched my YouTube videos. I've covered a lot of different ideas and perspectives and concepts over the last couple of days, but I now want to combine all of them into one big ball and how they correlate to each other. So I made a post today on my X account. I do these weekly. These are my weekend updates where I cover what's been happening over the past few days and what we could expect in the next couple of days, so next week. What I've been tracking on the low time frames currently is, okay, Bitcoin has gone up, but we want to see how it has gone up. So the price action that led to Bitcoin going up and the road we took to from $74,000 to $94,000. So how did we get there? And we see that a lot of untapped lows have been left behind. So I highlighted some of them. There are a lot more. This is a 30-minute time frame, and not even on the 30-minute time frame can we see these lows getting swept. Not even on a time frame so low. So because of that, I think that this market structure isn't really healthy. And I've made a case on this on what a healthy market structure means and how it would look like. There's a difference between a spot driven rally and a perpetual driven rally. Both are really different to one another. The first one, the spot driven rally, implies that it is a healthy price action with clear impulses up, followed by move down, which triggers all of the bids, takes all of the resting liquidity there, then the prices bounce higher. That is how a healthy market should look, in my opinion. There are a lot of different theories into this. We have the whole Elliott wave thing with impulsive and corrective waves. I think that correlating that with a lot of different other confluences on the order flows and order block and how market structure should look like is a really useful metric, and a really useful way to do so. So this is what I've been covering, and essentially I've made a case on this, on why these untapped lows tend to develop on the lower time frames. Some of you may have followed my thesis, throughout the past months around liquidation cascades and untapped lows. Essentially, what I think this leads to is, we have these series of untapped lows that tend to develop on the lower time frames. Then we had a tariff announcement. Each time we have seen a pullback or a liquidation cascade, it was triggered by a tariff announcement, and this is hard data. And this leads to these liquidation cascades. And I mentioned that I believe it is the art of counterparty, of market makers, to creating an artificial counterparty. And how it works, I explained it here. They build up these marginal higher lows, this series of marginal higher lows, which makes traders set their stop losses right at the nearest lows. So for example, if I'm a trader, right, and I would like to take a long position at these levels, I would set my stop loss at the nearest low, which would be this one. And by doing so, on a midterm basis, this creates more and more levels where stop losses are set, and that eventually leads, if there is some news or some event that takes place in the markets, that can trigger all of those stop losses, and that leads essentially to that liquidation cascade. But what that really does, it triggers a whole lot of forced sell orders, because the stop loss of a long position means a forced sell order, which is later on used by the market makers who would like to accumulate and who would like to buy as a counterparty. So that has been my thesis over the past months, and by identifying this series of untapped lows, I managed to hedge myself at range highs, scale out of my protective shorts, then DCA back in, and this is how I managed to accumulate even with the prices continuously going lower and lower. So here I explained the idea behind why healthy market structures should be around clear impulsive waves followed by pullbacks, because there is a constant battle between bids and asks. And here I explained the difference between a perpetual driven rally and a spot driven rally. That implies a high spot demand. So essentially, a perpetual driven rally is basically a short squeeze in action in this case, right? It can also be to the downside, case in which we have that liquidation cascade I covered earlier. So oftentimes we have these series, we have this perpetual driven rallies that are essentially a short squeeze. But the problem with these are, we have short-term rally, we have short-term momentum. Everybody is excited once again, as I covered in the beginning of this conference. The fear and greed index has flipped back into greed territory. But unfortunately, these perpetual driven rallies aren't that sustainable, right? And once shorts get squeezed, once there are no longer those shorts to be squeezed, then market makers simply flip on the other side, and they start targeting longs. And that is when the problems come in, especially when the price action looks like this, with all of these untapped lows getting left behind, which mark liquidity points. When eventually the trend reverses, these traders get margin called, let's say, and that leads to, once again, a deeper pullback. And you'll understand in just a few minutes why I'm tracking this so closely. And essentially, in more extreme cases, this pattern of perpetual driven rallies can lead to blow off tops, followed by sharp corrections. Now, why am I bringing this up, and why am I paying so much attention to the low time frame price action? So, as I mentioned a couple of minutes ago, there can be a complacency range for Bitcoin that could form in the next couple of weeks. And we must understand that the low time frame price action shapes the midterm structure in the markets that then shapes the high time frame trends. So it all lines up like a domino effect. So how the low time frame price action develops is how the midterm structure would form, and this defines the high time frame trend. Because of that, this is why I've been paying so much attention to the low time frame price action, because now we're currently at an inflection point. And as I highlighted when we were at range lows at $74,000, I said that the next reversal will be the one that we should track. Now we're in this reversal, and this is why I've been tracking it, because my base case currently is that we'll see another major leg up into the $140,000-$160,000 range, followed by a topping or distribution phase. So that is my base case, right? I covered it in this conference as well. I covered it in my prior videos as well. That is my base case. The second scenario, however, implies that the cycle top is already in, and that we're currently building a complacency zone where sentiment remains euphoric and longs keep piling in, setting up for a bigger trap later. This is quite important because if low time frame price action develops like this, if there are a ton of long positions that have been left behind current levels, and the prices keep on going higher and higher and higher, well, that could very well lead to the complacency zone, where a lot of people are feeling really euphoric, really excited, are starting to call for a new all-time high. And the midterm structure, as I mentioned earlier, which is formed by the low time frame price action, is looking really weak, and we'll eventually have this sort of consolidation phase that actually is the distribution one. And with all the untapped lows sitting below, that could very well lead to a continuation of the drop. So this is why I've been paying so much attention to this. So what I wish for, and a lot of people seem to be preferring the other option, what I wish for is that we'll see a short-term correction that will lead to a spot-driven rally, meaning that we'll have a short-term pain in the markets. So moving to the charts, we'll have a short-term pain, essentially a short-term correction. This is the short-term pain followed by a long-term gain and a sustainable rally ahead. If we see this, I would be extremely happy, because it would mark that this is no longer just a perpetual driven rally and an unsustainable upside momentum, but it is a healthy market structure that has developed, and it implies all the spot positions getting filled, of the spot demand, all of the bids getting filled, and that is something that we like. That is what leads to a healthy market structure and to a sustainable upside momentum. If we just continue going up and up and up, right, piling in more and more longs without properly flushing these liquidity levels, then we risk seeing eventually this range, when we'll approach this range, let's say the $100,000 to $105,000 range, we'll reach that phase, we'll start to struggle, we'll start to form bearish divergences. If then we'll see a distribution towards altcoins and a very high risk appetite of investors and euphoria making a comeback, this will most likely coincide with that complacency phase that I discussed, and that could very well lead to a large sell-off in the markets, as all of these untapped lows that have been left behind would get all of the sudden triggered. So that's why I've been paying so much attention to the low time frame price action. And now it may seem crazy at first that we would want short-term pain in order to have a long-term gain, right? It may seem crazy to say that pullback is actually the one that leads to more upside, but it is true, and history confirms it. It is encountered all over past cycles that unsustainable upside momentums rarely lead to a continuation to the upside and healthy price action ahead, right? You cannot have that. So it rarely happens, and I doubt it would happen in this case. So this is why I've been tracking it, and if the price action keeps pushing up with proper corrections, we could essentially be setting up for short-term pleasure but long-term pain situation, which would trap a lot of late bulls. What we really want, as I mentioned earlier, is the short-term pain for long-term gain scenario and healthy corrections along the way that strengthen the foundation for a more sustainable upside move. Okay, so as I mentioned here, that's enough lecturing for today. Let's really think what's going to happen moving forward. So I made this comparison with the September price action. And back in September, we had this reversal that was really similar to what we saw now, where there were a lot of untapped lows developing on the lower time frames. That eventually led to this short-term pullback, but that led to a healthy and sustainable upside momentum, which drove that rally to $100,000. So I made the point: could we be here right now on the low time frames? Could we be in this range? And if we look at the charts, it is pretty similar to how it looked back then. So it could be this one. And if that happens, in my opinion, it would coincide with a corrective wave 2. So as I highlighted here, this being the first impulsive wave, then followed by a corrective wave 2, and then the rest of the impulses up, wave 3, wave 4, wave 5. If we look at some technical confluences, we'll see that there are some bearish divergences currently forming on technical indicators, such as the RSI. A bearish divergence occurs when the price forms a higher high while the technical indicator forms a lower high, suggesting a weakening trend. And in the scenario where we're currently testing a high time frame resistance range, which is this one, which as we see in the past has acted as a support range, it's likely that we could see this rejection and corrective wave 2. But once again, I think that we shouldn't be afraid of pullbacks along the way. I think that they are healthy and lead to a more sustainable upside momentum. So back in early April, I made a post highlighting a bottoming formation. Now this was the post I made when everybody was panicking all over X, and everybody was thinking that a recession was going to follow next, and that Bitcoin would go into the 60s and so forth. I made a post that it's likely that we'll see the bottoming formation here at $72,000. This is where I thought it would happen, which would precede the next move to the upside. But this move was never intended to be in this straight line. It has ups, it has downs, it has ups, it has downs. That's how a market works. It doesn't go up in a straight line. So this is also something I emphasized in my weekend update, that losing the bigger picture out of sight is never a good idea. However, at the same time, adapting on the lower time frames is just as important. And that's exactly what I've been doing. Because as bullish as I am on the high time frames, as I mentioned in today's conference as well, in past threads, in past videos, as bullish as I am on the high time frames, I never let my personal bias, take over me. I never let that bullishness, let's say, to take over and me becoming irrationally bullish on the low time frames, because we must adapt to what charts and other conferences are telling us, especially when we want to trade on the short term. So this is what I've been doing. I've been hedging range highs, scaling out of my protective shorts, and DCing back in. This is what the strategy that has kept me alive, let's say, over the last couple of months. And because of that, I'll keep following the system that's worked for me until data tells me otherwise. And then once again, I'll adapt and I'll adjust my system according to new market circumstances. So this is pretty much where I'm standing right now for Bitcoin on the lower time frames. And next week, by the way, I have some upcoming videos regarding the macroeconomic side, as well as the potential of a blow off top phase in the next couple of months in risk assets and Bitcoin as well. So make sure you stay tuned for that as well. Make sure you keep those notifications on. And with that, this is pretty much what I had to say for today's conference, for today's weekly market wrap up. So this was pretty much it. It's been a really good talk. I think I've covered a lot of topics today, and I hope it makes sense on a broader scale. I hope it all relates to one another, and it was a really interesting discussion. So I'll post the recording later today. For those that join it late, you can watch it. You can watch it on YouTube. Thank you all for joining, and make sure you stay tuned for some upcoming events that will be soon live, especially with tomorrow's space on X. I'll be having some amazing speakers that will also come by, so make sure you stay tuned for that and for all of the videos and threads that are on way. Thank you all for joining once again. I wish you all have an amazing evening and weekend ahead, and I'll see you guys in the next one.